Hello, this is Samantha Shares. This episode covers NCUA's proposed incentive-based compensation rule. The following is a summary of that 200-page proposal. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in-process NCUA examination, reach out to learn how they can assist at marktrickle.com. Also, check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the summary. The proposed rule implements Section 956 of the Dodd-Frank Act, addressing concerns about flawed incentive-based compensation practices that contributed to the 2008 financial crisis. It builds on previous proposals from 2011 and 2016, incorporating supervisory experience and industry developments since then. This regulation covers financial institutions with $1 billion or more in assets, including banks, credit unions, Federal Home Loan Banks, Fannie Mae, Freddie Mac, and certain subsidiaries, but excludes functionally regulated subsidiaries like broker-dealers and investment advisors. The rule establishes a tiered structure with Level 1 institutions having $250 billion or more in assets, Level 2 with $50 billion to $250 billion, and Level 3 with $1 billion to $50 billion, applying more stringent requirements to larger institutions. Key definitions in the rule include covered persons, executive officers, employees, directors, and principal shareholders. Senior executive officers define roles such as CEO and CFO, and significant risk takers determined by compensation level and risk exposure ability. All covered institutions must prohibit excessive compensation, ensure incentive-based compensation appropriately balances risk and reward, maintain board oversight of compensation programs, and comply with specific disclosure and record-keeping requirements. Level 1 and Level 2 institutions face additional requirements, including mandatory deferral of a portion of incentive-based compensation, forfeiture and downward adjustment policies, clawback provisions, prohibitions on certain practices like hedging, and enhanced risk management, governance, and policy documentation requirements. The rule provides regulatory flexibility, allowing regulators to apply stricter standards to Level 3 institutions if warranted and providing for modifications as institutions change in size. Implementation is proposed for 540 days after the final rule's publication, with grandfathering provisions for existing compensation arrangements. The proposal considers international context, discussing related developments in the European Union and United Kingdom and aiming for alignment with international standards. Extensive regulatory analysis is included, covering economic impact, paperwork reduction, and regulatory flexibility considerations. The agencies are seeking public comments on numerous aspects of the proposal, including consideration of alternative approaches in certain areas. The rule is jointly proposed by the Office of the Comptroller of the Currency, Federal Deposit Insurance Corporation, Federal Housing Finance Agency, and National Credit Union Administration, with the Federal Reserve and SEC noted as not participating in this specific proposal. Enforcement provisions are included, along with considerations for how the rules apply to institutions in conservatorship or receivership. Overall, this proposed rule represents a comprehensive attempt to regulate incentive-based compensation in the financial sector, balancing the need for effective compensation practices with concerns about potential abuse and systemic risk, with the ultimate goal of promoting financial stability and preventing excessive risk-taking. This concludes the summary. If your credit union could use assistance with your exam, reach out to Mark Trickle on LinkedIn or at marktrickle.com. This is Samantha Shares, and we thank you for listening.